So hello and welcome to the Data Explorers Market Update with me, Will Duff-Gordon. So short selling remains a very topical item in the news at the moment. France has joined the UK, Japan and Australia in disclosing publicly short positions over a certain size. And then there's some research out by some people from the Texas University as to how people should actually follow short selling. So it's actually a pretty good time for us to be joined by Altaf Kassam from Deutsche Bank to talk about a bit of research that has been done, because rather than railing against short selling, you can actually use it to basically get information and use it as part of your stock screening process. But I might begin by just saying how are kind of quants doing at the moment in this environment? Those people that are screening for stocks and trying to trade programmatically, is it a target-rich time or not very easy?
Yeah, I think it's fair to say that since the quant crisis, which started in August of 2007, quant clients have generally suffered from lower returns and more volatility in their returns, and that's led us to look for more sources of what we call alpha or outperformance in the stock market. So we've used lots of different data sets, and in particular something like short selling, which hasn't been explored before, gives us a great opportunity to start to outperform again. So it's a very topical topic. Excellent.
So yeah, it's a challenging time, but the novelty of this data set could be what's useful.
Definitely,
to it. Yeah. So in this research you've done, is there anything that's, groundbreaking is a strong word, how different is it maybe to other pieces of information that are out there?
Yeah, I think what we've tried to do, and I would also hesitate to use the word groundbreaking, is we've tried to make this as practical as possible. So a lot of the academic research which you just mentioned, a lot of the other practitioner research that we've seen, uses short interest data, but doesn't really think that deeply about how you could actually implement a strategy. The fact that a lot of the alpha, as we say, has come on the short side by shorting stocks which are already hard to borrow, could actually make you realize that it's going to be a very difficult strategy to pursue. So here we very much try and take out the stocks that are hardest to borrow. We try and find the stocks that are going to be squeezed, because obviously that's a massive risk for anyone who's shorting stocks. And we try and come up with a strategy that we could honestly put in front of most fund managers and they'd be able to implement it.
Yeah, but the first thing that struck me when reading the paper was that within about page 3 or 4 you had top 10 short stocks to go overweight or long, top 10 longs, top 10 shorts. So kind of like all the kind of explanation was in the back, because you're very much trying to sort of actually make it quite practical and read it, which I thought was very much the case. So then so cutting to the chase and difficult in this kind of format without going into Spearman rank coefficients and things, but how much sort of money is there in this? You came up with 3 factors. Give us a little bit of a headline as to how much alpha there is.
So what we did was we looked at the Data Explorers data set, and the great thing about that is that it has a number of factors that are already kind of prepared for the user to isolate and to use in terms of quant investing. So we looked at demand, so how many shares were people actually borrowing at the moment. We looked at supply, how many shares were out there, and we looked at fee, how much it was costing people to borrow these shares. So those were the 3 main families that we looked at. We picked one factor from each. That's because we wanted to diversify among those factors. So we didn't want to be in a situation where all our stocks were just the ones with the highest fees, or all our stocks were the ones that were in the shortest supply, in case there was some kind of shock to the system. So we chose those 3 factors so that we could diversify. We put them all together. We ranked the stocks based on those factors. And then what we did was we put it into our already successful quant investing model to see if it could improve it, and it did. So we feel very confident that using short interest data in a sensible, diversified way actually makes sense in terms of a broader quant.
And then crucially, it's not going to decay, or it's not going to become a zero-sum game, because obviously that's the next question you get, because everybody says every piece of data could be good, but the question is, well, if everybody's using it, what happens next?
Exactly. So in terms of decay, what investors worry about is that the stock that they pick today won't be the stock that they pick tomorrow, so they'll have to keep turning over their portfolio, and in reality transaction costs can eat up a lot of the alpha. So we've deliberately tried to find factors that, as you say, decay very slowly, so that they're the same stocks, to within a high percentage that you have this month, that you had last month, that you had the month before. So you don't have to keep churning your portfolio, and hopefully you can keep a lot of the alpha that you've generated.
So when we talk about short selling and security selling and borrowing, quite often we think about this is a long short. This is for hedge funds who short or short biased funds. But you came out with a sort of actually useful beyond just short selling.
Yeah, I think what might be surprising to people who read this paper is that there's actually a lot of value for the long-only manager. So like you say, at the beginning of the paper, we come up with a list of stocks to go long or overweight. We come up with a list of stocks to underweight, and we also do have a list of stocks to short. But in my view, this is almost more valuable for the long-only manager, because by going underweight the stocks that have information from the short-selling market, they can actually benefit from the information that's in the short-selling market without having to incur the costs of actually borrowing the stock. So in some senses, they get the benefits of the short-selling market without actually having to take on the high fees which can sometimes be present when you're looking at hard-to-borrow stocks.
Yeah, and that was one of the oldest arguments for being a long-only manager lending, was that you could pick up some information from people who were borrowing your shares.
Absolutely.
But in reality, no one's really kind of like sharing the information across the firm. So finally, where do you think it could go next? I mean, what's the obvious next place to take this research? You looked at sort of how it compares with some of the other papers out there, but is there a big thing that could be next?
Well, definitely this research that we did is only on the US market, so we'd like to take it global. We have Data Explorer's data, thankfully, for Europe and Asia, which we're going to examine in the same level of detail and come back with our findings. We also want to do more work on squeezing. So what makes a stock prone to squeeze? We think that's a question that a lot of investors have, and something that obviously if we could answer would be hugely valuable to
Did you call them reverse torpedoes as well?
Reverse torpedoes, yeah, because we talk about torpedo stocks which just keep going down. These are stocks which go up very sharply.
Okay, yeah. I can see the name for that paper. Okay, so you're kindly coming to our forum in London, I think, to do a bit of a Q&A and a short session there. If anybody actually is fed up with how high level this is and would actually like to ask a proper question, then you can send your questions to dataexplorers.com/questions. If you'd like to read a little summary I've done on this research and the other academic research out there, it is in the usual place at dataexplorers.com/news.